Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical, driving markets at the moment. So I just let you have a look at the disclaimer and have a read through that. Currently, we see markets pretty quiet this morning, Asian and Eurozone stock markets at least not showing such a clear directional trend really. US futures marginally in the green. This week the calendar is relatively thin. That's the risk event calendar really. There are a lot of speakers, actually Fed and ECB speakers, who will be important probably. That is, they are able to give probably their final guidance in the run up to the early May policy meetings. That's the Fed meeting on May the 3rd and the ECB meeting the next day. So that is something to look forward to in a couple of weeks' time. For this webinar anyway, we'll check out Friday's PMI data out of the Eurozone. That's the most high profile data out of the region this week. We'll also do a dive into UK markets that receive really quite an extensive data update this week. We have employment data Tuesday, CPI Wednesday, retail sales Friday. That's in the UK. That is the sort of mid-month norm, actually. If you check out the calendar, we normally in the middle of the month do get this data sort of dump, this deluge of UK data, middle part of the month. And it will be important as markets really ponder whether the Bank of England pause potentially after this hike, quite highly priced now, about 19 basis points, I think, priced in for the Bank of England meeting the following week after the Fed and the ECB in May. We also get some Chinese data, GDP data out tomorrow, and retail sales, industrial production, I think, out of China as well. And then, of course, investors will be keeping a close eye on Q1 corporate earnings and guidance, which we'll look into as well shortly. After last week's rebound in US yields, markets really now positioned more for a neutral stance, really, compared to before US non-farm payrolls. It does seem likely that the Federal Reserve will deliver one last 25 basis point hike in May, and then really hit the pause button to wait on the effects of the tighter credit conditions really caused by the March banking stress and turmoil. If that is then the case that we get this 25 basis point May hike, I think about an 87% chance now money markets give that of that happening, then potentially it'll be interesting for the dollar and potentially won't rally too much further in the short term. FX wise then, we can see the year-to-date charts that we like to pull up. On the left-hand side is last week's year-to-date performance, and the right-hand side is just a snapshot I've pulled off a few minutes ago. Not too much change. You can see the Swissy has sort of taken the lead in the majors. This is all against the dollar year-to-date. The Swissy actually moved down below 89 last week. Levels not seen for a couple of years, actually. Sterling, euro still obviously strong. These European currencies strong, with markets expecting more rate hikes from these three central banks at least, then compared to the Antipodean currencies really, and obviously the yen, which are seen as pausing really, their central banks at least. And definitely last week at least, we wrote about this in our daily commentary. Hopefully you guys read some of that, which is on the website, of course. Key levels in the euro dollar, key levels in cable, so sterling against the dollar, and they're now back below 110 for the euro, below 125 for sterling. At the moment, dollar yen's kind of testing 134, so 1 week highs or so. And the dollar, of course, did find support late sort of last week, Friday, comments from Fed's Waller, who is a known hawk, and also the sort of mediocre US retail sales. As I said, markets now giving a strong chance of that 25 basis point hike in that May meeting for the Fed. Key this week then and going forward, of course, are there's a lot of focus around earnings, really. And those are Q1 earnings will be sort of taken to another level, really, with important earnings from, or releases actually, from Netflix on Tuesday, Tesla on Wednesday, and that's all then accompanied by multiple bank results from the big investment banks. Again, we saw that from JP Morgan, Citibank on Friday. This week we have Goldman Sachs, Morgan Stanley, but we also have as well, interestingly, Charles Schwab today. And then also other regional bank names in the US. Generally, these don't get a lot of focus, of course, in earnings season, but of course, suddenly they're all in the spotlight because of the sudden collapse, of course, of Silicon Valley Bank in mid-March. And then, of course, all these signs that some depositors were moving their funds to these big global systemically important banks, if you like, but the big investment banks which have a retail franchise, then they're hoovering up these deposits from these smaller regional banks, which have gone to them, even into US treasuries as well. And given the unprecedented sort of pace of declines in US commercial bank deposits in recent weeks, then there will be some focus, as I say, on these smaller US regional banks, and we get a few of those this week. US Bancorp, probably the bigger name on those sort of smaller banks that they're reporting Wednesday, and there's a handful, quite a few, several others actually all reporting across this week. So will be of some interest potentially to markets, just seeing whether these outflows are really serious or not, and how they're then impacting these Q1 results for these smaller banks, and then obviously the bigger banks as well. As I mentioned, we do get Tesla and Netflix, of course, very popular stocks. And it'll be interesting for especially Tesla. There is some focus on their margins, first quarter margins. They're anticipated to have hit more than a 3-year low as the electric vehicle maker slashed prices really to lure more buyers in the face, of course, rising competition and also the weaker economy. That will certainly boost quarterly sales, and as we put in our week ahead, actually, which we posted over the weekend, then for Tesla, the key sort of target for them this year is a 1.8 million vehicle sales number. Delivering that is key. Elon Musk actually said in January that potentially the automaker could hand out even 2 million vehicles if circumstances were favorable. So the focus will be on those margins and then on those sales figures for Tesla. Otherwise, for bank earnings, earnings in general, again, I put out a piece just about FactSet. They're sort of estimating that Q1 earnings for S&P 500 companies could decline by nearly 7%, and that would be the steepest decline since the second quarter of 2020. And in fact, if that was to materialize, it would be the second consecutive quarter of negative earnings growth, really signaling a sort of earnings recession. Bloomberg consensus expectations actually calling for a bigger slide, around 8% in EPS for the S&P 500 companies. Most declines coming from healthcare, materials, IT, and consumer staples, while energy and utility companies expected to still post positive earnings growth. Kind of all it says, there will be some beats, of course, as expectations are very, very low. So it will be interesting to see how the season develops from here. As for US stocks in general, They fell, of course, on Friday slightly. Investors kind of looked past the rally in bank stocks that we saw after some of those better earnings from, as I said, some of the biggest lenders. JP Morgan up 7.6%. That sort of led the gainers. It beat estimates with Q1 profit rising 52%. Wells Fargo and Citi, as I mentioned, also exceeded analyst expectations. So kind of markets on Friday at least looked beyond those better results and focused on the outlook for interest rates. The S&P added 0.8% on the week. Actually, the Nasdaq gained 0.3% across the 5 sessions last week. And we kind of had a conflicting picture, really, of the latest data, at least over the recent last few days, sort of half empty, half full. Leading indicators pointing to a US recession over the coming year. Then you could also point out, of course, unemployment around its lowest in decades, plus signs that price pressures are softening. And the Fed is, of course, close to a potential pause in its most aggressive policies tightening seen in decades. We'll get on to, of course, a quick review of that CPI data. We always do a big review for or of the most important data we see anyway last week, and then obviously a preview of what's happening this week. Just on equities then, technically, this is the S&P 500 weekly chart. You can see sort of a couple of weeks ago, we had that doji candle. So sort of indecision really just after that nice push higher. But bulls have just, you can see, closed above that sort of long-term trend line resistance, potentially now support. So interesting there. This looks like sort of a key trend line really after you see in late January and February when we couldn't actually break and close above it. So 3 times there, we sort of touched that trend line, reinforcing the sort of validity, if you like. We've just closed above that. So interesting price action coming up really. Last week as well, we finally did, we did close above that trend line, as I said, but we're still below that 50% mark of the 2022 decline, which is at 4155. So that's that dotted line there. Hopefully you can see. So we did close below that 4155, of course. But potentially, if we can push above there, then we've got this resistance level still, the late January high at 4195. And then also that gray line there is actually the 100-week moving average at 4203. So around 4200, sort of probably strong resistance for this move if it continues higher. Near-term support probably is around 4069, 4072. That was last week's low and the previous week's low. So that's the S&P 500, NASDAQ 100, S&P 500, NASDAQ 100. If we just go to the weekly, which we still have on, again, a doji sort of candle a couple of weeks ago, then sort of close above that key line of 12,880. That's the late January high. So the inside candle then also then an inside week, and then last week was also another inside week, inside candle, if you like. So all the range falling inside the previous week. So a narrow range kind of just signals consolidation really after that recent breakout higher. Interestingly then, whether we can hold above 12,880, then certainly it looks like it's bullish consolidation, and potentially we break above sort of 13,204, which is the target to the upside. And then above that, you've got that 100-week moving average, which just around tallies about with the mid-August high, around 13,461. On the daily, you can see then that sort of consolidation there above that previous high, 12,880. So that's strong support really for us. Consolidation going on quite a long time. So really, we'd like to see that sort of bullish consolidation after the break higher, probably over a shorter period, and then a push beyond those highs. So the longer we track sideways, of course, the bigger the breakout generally will be, sort of range expansion after range contraction, and it should be in line with the sort of uptrend, the dominant trend, which is for higher prices. But the longer it does track sideways, then potentially we sort of topped out and we roll over, which yes, support would be around that 12,880 mark. That's the NASDAQ 100. Just for the Dow as well, always like to look at all these major indices just on the weekly. We had 4 straight weeks of gains, and we've pushed above that 100-week moving average at 33,667. You can see really this strong resistance just above here now. We pointed out over the last few months now, 34,281 is a key level you can see, which is the mid-August high. We couldn't close really above there. November, then even January as well. You can see us tapping that line of resistance and then sort of rolling over. So really interesting whether we can keep this bullish momentum after these 4 weeks of gains, push up towards that and even beyond it or not. We're not overbought at all. Pretty neutral, really, just above neutral. That weekly RSI at 55.76. If we just go to the daily now, you can see that nice, really bullish channel, really series of higher highs, higher lows, and there, and then just this pullback on Friday. Not too bad to see some sort of consolidation after these strong days, up days, if you like. But of course, we want to break above last week's high at 34,082 to see then 34,281 or so. I think also worth looking at some of these European indices. They've been motoring higher, really surging higher. The DAX weekly, if we just pop to that, you can see this strong break higher that we saw. That was a late March weekly advance of over 4%, 4.3%. That big green candle there, really strong up to the recent highs. And then this sort of doji candle to be expected, as I say, after a big move. But that was sort of not indecision, but consolidation before then, another push higher last week, breaking those previous highs, closing strongly as well, although we're sort of, we're pretty flat today. So quite bullish price action, really, as we look towards, or the bulls look towards 16,000 at least, key level. And then you've got sort of 16,294 before sort of this November high at 16,355. That's the DAX. And then sort of support probably should be around 15,707, which was the previous cycle high. Also, the FTSE, interestingly, I think if you look on the weekly again, you can see strong bounce from those sort of mid-March lows, the lows tapping sort of 7,200 or so, fib level there at 7,219, and then this strong bullish move higher, 4 weeks of consecutive gains. We're now sort of back towards the, well, we pushed above the sort of January 2020 top at 7,689. That's that first. Don't want to get too complicated, too many levels, but that's the first long dotted line there, 7,689 from the January 2020 top. And then this dotted line is from actually back in May 2018, that high at 7,903, and we're just pushing towards that now. Really interesting whether we can get another week of gains, and then we push up towards the high, obviously at just above 8,000, 8,047, the February peak. Resistance probably clearer that you can see there on the daily. Just consecutive gains, daily gains, actually, incredible daily run, 13 out of the last 14 days. You can see a green, that's 6 days, then a pause, and then 7 days of gains, I think. So, yeah, just still not overbought. Actually, on the daily RSI, you can see 64 or so, so still got some way to go, but then coming into sort of strong resistance around 8,000. That's on the FTSE. Okay, let's get to just last week's main data, which was the CPI, US CPI numbers. Just got the graphic here with those main numbers, really. Consumer price inflation rose on a monthly basis, at least 0.1%. That was below the 0.2% rate expected. And then core CPI continues to run hot, rising 0.4%, which was in line with expectations. That all means the annual rate of core inflation rose to 5.6% from 5.5%, despite, of course, the headline number, this 5% number, dropping from 6%. We focused on the core month-on-month number, really. That's 0.4%, which is still running at more than double the 0.17% or so month-on-month rate economists generally think is needed to be averaged over time to bring the annual rate of core inflation back to the 2% target. So that is something to bear in mind. Of course, we are going in the right direction, of course, definitely. But policymakers remain nervous, certainly. And of course, that Fed speak for this week will be important before the blackout period, ahead of course, that FOMC meeting that we said, which is on May 3rd. Going forward for inflation figures then, it's all about really shelter costs, which have a lagging effect. They've been a big contributor to sticky core CPI, but they are seen falling in the months ahead, according to numerous leading indicators. And I've just got a couple of charts here. You've got the core services against the core goods. We've had this chart before in a different format, but you can just see the core services still sort of rising, although just slowing slightly. And you can see the big tumble in core goods figures. That's for US CPI, of course. Then we've got another chart in here just showing you potentially how prices are now slowing. The dotted, the red line is the month-on-month change in core CPI, ex shelter costs. And then the dotted line is the sort of longer-term 6-month average, which is now falling. So yeah, just a few charts there to take in, really. Just really then, if we do get that hike, markets thinking that's then, as I've sort of said, the peak for Fed funds rate. It's the combination really of higher borrowing costs and then these tighter conditions after, of course, a banking crisis will inevitably result in or will result from the fallout of those stresses that we've seen over the last few weeks. And that kind of heightens potentially the risk of a harder economic landing and then bringing inflation much quicker back to potentially its target at the end of this year, potentially early next year. Interestingly, well, for the Fed, if you think about it, the dual mandate of price stability and maximizing employment gives them sort of greater flexibility, if you like, than other major central banks. But assuming inflation slows rapidly through the second half of the year, and then unemployment starts to pick up towards sort of 4% and above, towards 4.5%, which I think is the Fed's forecast, then there is the potential, if that plays out, for then the Fed to cut rates possibly before the end of the year. That also means, actually, just sort of thinking bigger picture then, in the months ahead, potentially we should look out for a shift by the Fed in their stance, with policymakers kind of not quite so keen to probably obviously push their inflation fighting credibility so much, and then they'll be more focused on the employment side as unemployment picks up. So just something to bear in mind longer term, we think, around the Fed, their speak, obviously, and the speakers that we get obviously this week probably focusing on the near-term inflation issues, but then potentially further out, they may change tact. Last week as well, we did get FOMC minutes for the March meeting. They showed really that members are divided on the outlook, some emphasizing the need to be flexible as growth risks have increased, while others still worried about, as I said, those upside risks to inflation potentially. Still, the committee leaned towards that hike, another rate hike after the March meeting. But there were concerns, of course, around the credit crunch, which did weigh on the outlook, with Fed staff advisors really forecasting a mild recession later this year, which is now their base case, the Fed's base case even though they see rates slightly higher. Certainly, it's around the banking sector concerns, which of course have cooled further since that meeting. But again, it's the longer term effects around tighter lending standards, tighter regulation potentially as well, all impacting economic activity, lending to businesses, consumers going forward. Also, other data, just briefly last week, we had bigger initial jobless claims. That was sort of picked up on by the markets on Thursday, if you remember, risk assets rallying, also on softer PPI data. So that's factory gate costs, if you like. That sparked a big risk rally, as I said, Thursday, really. And then Friday, we had kind of retail sales out of the US, kind of mixed. Headline retail sales fell 1% in March. That was deeper than the expected decline to 0.4%, and the prior negative 0.2%. But core retail sales were also weak. And the control group, that declined by 0.3%. So slightly better than Bloomberg consensus estimates. Let's just look at the DXY actually. So that's the dollar chart, of course, against so the dollar against 6 of its major trading partners. I've left in this channel here still a bear channel. Let's just extend it out and make sure it touches at least one line. Yeah, pretty neat bear channel from those early March highs, actually just before the banking crisis. Series of lower lows, lower highs, really. We sort of pushed up, off the lows from back in February. You can see 100.82. We tested those a couple of times last week and bounced really interestingly. So that'll be major support now, just below 101. And then top side, really, we're pushing up towards 102 if we do break out of this channel, or then we push back lower and then we head towards sort of 101 and below potentially. That's the DXY chart. Also last week we had the Bank of Canada meeting. Just to recap, this is dollar CAD chart anyway. Bank of Canada, they left rates unchanged as expected at 4.5%. So really, it was the sort of conditional pause, if you like, which they mentioned before. That was simply extended. Policymakers, they sounded more optimistic that hard landing would be averted with inflation falling. How quickly prices slow to 2%, that 2% target was less clear, though, and Governor Macklem took the opportunity actually to underline that policymakers had discussed the likelihood that policy would have to stay higher for longer to curb inflation. So just sort of thinking with a Fed hat as well, that's interesting from the policymakers at the Bank of Canada to make things actually even clearer. Macklem as well stated outright that rate cuts implied by market pricing by year end do not look at the most likely scenario now, is what he said. So again, just a nod, or just thinking about the Fed as well, and potentially what they've been saying, what Fed speakers might say this week as well, and obviously what's implied in the the most recent dot plot. No rate cuts implied by those dot plots by Fed officials for this year, whereas markets have around 50 basis points or so, a little bit more, I think, or a little bit more last week at least. So we have this difference between what Fed officials think and the markets pricing in, and something will give at some point. And certainly that will impact the dollar. But anyway, for Bank of Canada, clearly a major goal of the press conference was actually to push back on that market pricing for a rate cut by year end in Canadian money markets. And they continue actually to price in a policy rate of around 4.25% in December. That's from obviously 4.5% now. In Canada as well, we do get CPI actually moving on to this week. Prices seem rising 0.5% month on month in March, with the annual rate of inflation expected to pick up to 5.4% from 5.2%. So interesting what consensus thinks there. There will also be attention on the Bank of Canada's 3 core measures of inflation, which averaged just below 5.4% in February. In fact, the Bank of Canada actually added last week that bringing down inflation to target is, as I kind of mentioned, is more challenging due to inflation expectations falling only slowly, while services price rises and wage growth remain elevated. For dollar CAD weekly, let's just check out this weekly. A kind of, yeah, it's sort of a weekly triple top, possibly. It's not very, not a perfect triple top, but they never are really, I guess. But you've got a neckline potentially around or above 133. So a measured move, if you went up to 138, is 500 basis points. But as I say, potentially, yeah, the neckline around 133. So that's strong resistance potentially. And you also got the 50-week. That's the light blue line moving average just above 133 as well. So possibly if we break that, then we do break down lower below there towards then 130 at least, which is the 200-week moving average, which is that thick black line there at 130.55. If you just go to the daily, yes, you've got the year-to-date low, which is 132.62, and then we've got a sort of zone around sort of 132.20, 132.30. If I just go here, which is the high from last July, going back here, which is there, and then the low from November around 132.20, 132.30, as I say, and then resistance actually on the daily you've got, which is that breakdown lower through that thick black line, which is the 200-day moving average at 134, which tallies with that sort of pivot April low, 134.05. So resistance there, and then potentially looking down towards sort of 132.50 area, 132.30 if we do break down below 133, which is last week's low. That's dollar CAD. Okay, moving on to this week. Let me just pull up. Yeah, UK data is key. First of all, let's look at that before looking at the Eurozone PMIs, which are important for the Eurozone economy. UK data, we get, as I say, that mid-month slew of economic data over the next few days really will decide whether the Bank of England hike rates by another 25 basis points or not. Just got a chart here which has the pricing for the Bank of England currently. So far, bank officials really sort of largely refuse to be drawn either way on what they will do at its May meeting, kind of keeping their options wide open, if you like. Yeah, and firstly, we have, just before we look at this chart, actually just run through the data. So Tuesday, we have the jobs reports, expectations for unemployment to rise to 3.8% for 3.7%. Headline earnings growth, a lot of focus on that. Of course, they're set to cool, actually, 0.2 to 6.3% from 6.5%, actually, on a 3-month year-on-year basis. The takeaway from the last release actually was the stubbornness of the unemployment rate, which held steady at 3.7%. But clear signs actually that wage growth may finally have peaked, which is really important, of course, for the Bank of England. For this report, economists expect to see further evidence of that wage growth losing momentum over the winter, and that certainly bolsters the case for, not many rate hikes going forward, potentially. Of course, there is the tightness of the labour market. That's a key factor for the 7 members, really, who voted for that 25 basis point hike in March, really. And that was done on the basis that renewed and sustained demand for labour could still reinforce the persistence of higher costs in consumer prices. That was their quote unquote. And that sort of relates then forward towards the inflation data on Wednesday, expectations are for the headline number year on year to fall to single digits, actually the first time since August, at 9.8% from 10.4% previously. The call reading as well set to call to 6% from 6.2%. And then just if you remember the prior report, that saw an unexpected increase actually in that headline to 10.4, as I say, from 10.1. Consensus had been for a drop to 9.9, so quite a shock there. Whilst the call rate unexpectedly as well advanced to 6.2 from 5.8%. I mentioned it just in that jobs report about persistence, and that's key for the Bank of England, really, looking at core services inflation, but then highlighting really this persistence of inflationary pressures, which kind of means they're looking at the broader trend as opposed to sort of one-off data points, one-off indicators. Okay, money markets, always important, what they see priced for the next meeting around 19 basis points, so sort of a 76% odds really of a 25 basis point hike, so pretty much markets thinking, and that's a done deal. You can see then, so a hike up to sort of 4.5%, and then I'm just checking pricing now, actually, and then yes, potentially one more hike up to sort of 4.75 or so. Not really priced in though, so potentially then we roll over after that. As I say, it's about persistence of inflationary pressures rather than sort of just a one-off report. So bear that in mind, of course, even though it will be important data. Generally, we do get as well retail sales on Friday out of the UK and also PMIs. Retail sales been strong this year, certainly, and surprising many, but a modest pullback is expected on Friday but then with energy prices set to dip actually from summer and consumer confidence really off the lows, then potentially going forward in the next few months at least, it will be seen as the worst for the retail sector going forward. PMIs for the UK at least expected to be consistent with sort of relatively stagnant economic backdrop, which has been seen, of course, in the monthly GDP data. Just moving on to sterling then, the pound. Interestingly, this chart really showing how it tracks stock markets, risk sentiments, and in fact, the 1 month correlation between cable, so sterling against the dollar, and the S&P 500 has actually risen above 80% now to around 84%. And that really points to the main driver of the pound being the global investment mood, the sentiment around risk and stock markets, really. So that kind of explains why sterling has performed so well this year. Of course, S&P doing well, up 7% or so. Sterling doing well as we showed you with those bar charts at the start of the webinar. And then that, of course, implies that potentially any turnaround in equities could be damaging to sterling. Obviously, flip side, if we still see a prolonged sort of bid to equities, the S&P 500 challenging some of those marks that we pointed out, then potentially then we see sterling move above 125 materially. So interesting chart we thought there. Just on the technicals on cable, we'll just pull up the chart. Yeah, we mentioned before, obviously, this key level of 125. Obviously, we've stalled around there. The early March highs at 125.20. Couldn't quite close above there. Let's just show you on the weekly. You can see that weekly from last week, just around a doji. So sort of no sort of winners or losers really, closing around the middle of last week's range, but most importantly, closing below that previous high of 125.20. So potentially a struggle here. really need to push above there and close above there is important on a weekly basis for us to see then higher prices, and then potentially sort of 126.59, that level there from May of last year. And then you've also got those long-term sort of SMAs above that level. The daily, you can see just that sort of barrier around 125 or so. The high was actually 125.46 actually, but we've still got in there that marker from January, back in January, 124.47. Key for cable if it wants to move higher. Otherwise, near-term support, probably 123.44. Before then, we sort of get back into this sort of range here, which is around sort of mid 123s. That's cable. Also thought worth looking at Euro sterling because of the PMI data as well. We've had this range. We've still left in these dotted lines, which sort of sum up the recent range sort of trading that we've seen in Euro sterling between 87.21 and 88.66, really the low there and the high there. Obviously we pushed above it, but then sort of back into this range. We're now pushing towards that top of that sort of dotted line, at least anyway, and we've backed off today, at least you can see. So whether we stick in this range, and that's worth playing with the data coming up in sterling and obviously the Eurozone. Those PMIs just quickly then, survey data, of course, for the Eurozone, important leading indicators, will be interesting, especially given it's been providing kind of conflicting signals in recent months. The PMI has been upbeat, while European Commission surveys on sentiments shown really a more cautious picture of actual growth developments. The April data should provide some sense, or more a sense of direction for an economy still struggling slightly with this high inflation, of course, high core inflation in the Eurozone. But then obviously also experiencing some tailwinds from sort of easier supply chain issues. They're fading now, and really energy prices, of course, moderating. PMI data, specifically manufacturing, seen rising to 48 from 47.3. Services falling slightly from 55 to 54.6. That leaves the composite figure, so the combined manufacturing and services, at 54 versus 53.7. So still that composite number still above 50, still that boom and bust level of course is 50, expansion above, contraction below, so 54 still handily above that number, really. And going forward, the focus will be on, of course, recent banking woes, how that affects activity, with expectations, as I said, in the US, similarly, of tightening credit conditions, really, which began before the issues of last month, actually, and may weigh on activity through this year. Just on Eurozone, or moving on from the PMIs to the ECB speakers, I said we get those this week, with Lagarde speaking, I think, later today, Hawke, Schnabel on Wednesday. Last week we had again a sort of fight between the Hawks and more centrist dovish speakers, although interestingly Villeroy, who's an important member, said that inflation was more broad-based and potentially more persistent. He said actually that the tightening cycle was nearly complete, but that more hikes may yet be needed ahead. We also had a Reuters report out on Thursday suggesting policymakers are converging towards a 25 basis point hike next month. So that's from sources. Always important to look out for those just before the ECB meeting. Money markets, they expect the ECB to tighten by a total of nearly actually 75 basis points from here. So that means a 25 basis point hike each at the next three meetings, May, June and July. That would be, I think there's now just under a 30% chance of the ECB raising rates, actually by 50 in May now, with around 32 basis points priced in. So watch out for the speakers today, Lagarde and other speakers later this week. But in the meantime, 110, as we mentioned, is key for euro dollar. Couldn't quite break above there, and on the weekly we couldn't close above there either. We couldn't close above the year-to-date high, which is at 110.32 as well. So again, similar to cable, interestingly, whether we can push above it now or not. We're just slightly overbought, really, so that's why we've had a slight pause. You can see on the weekly, the 100-week moving average, possibly that was resistance. If we stay above there, then that acts as support at 109.35. And then we've also got the halfway point of the 2022 decline, or even the 2021-2022 decline. That halfway point, we've highlighted that before, that's at 109.42. So that may act as potential support as well for euro dollar going forward. Okay, we've covered quite a lot in the last 45 minutes or so. Hopefully that's been useful to you guys. No questions, but please do ask questions. I should have mentioned that along the way, and certainly going forward. Do follow us on social media, and of course we have our daily commentary on the website as well. Lots to look forward to in the week ahead, so stay safe out there, and good luck, and we'll speak to you at the same time next week.